Coronation Fund Manager's first half revenue increased 11% to 912 million, and an interim dividend of 95 cents has been declared. We're joined by Coronation CEO Hugo Nelson for a look at those results. Hi, Hugo.
Hello, good to
Just
be
looking at a couple of the top numbers, their diluted headline earnings per share 86.7 cents, the interim dividend per share 95 cents, that'll please the shareholders. The net inflows, that's one of your measures of how well you've done, 19.1 billion rand in that period, and you talked about robust equity markets, particularly in the second quarter. So what did robust mean, and how did you take advantage of that?
Yes, I think that perhaps we should have used the word like challenging. I think that we're finding the markets particularly challenging at the moment. Global markets had a very strong first quarter of this calendar year, the strongest in quite a while, which was sort of supportive. But then the sort of contra to that was Europe, where the uncertainty seems to persist, and right now, post some of these elections that we've seen, does seem to be weighing on markets in general. So, a bit of a mixed bag, challenging environment in which to operate, but we're quite happy with how the flows, as you've pointed out.
Well, the uncertainty in Europe's been going on so long, it's become certain that there's going to be uncertainty.
Yes.
What is your mix there? Because you talk Europe, but there are other places to invest. There's South Africa, of course, where the JSE Aussie hit a record not long ago.
Yes. Our biggest exposure is to the JSE. So roughly 60% of the assets that we manage are invested on the Johannesburg Stock Exchange, with in the order of 15% invested outside of South Africa in some of these global markets. From a prospective return perspective, let's say over the next 10 years, we think that investors will receive better returns from global markets, partly because the valuations are very undemanding. The valuations are undemanding because of these sort of certain uncertainties that we've been speaking about.
We've talked on the show here about sectors in South Africa, you say you're well exposed there, which are have run very hard, like listed property and retail. Values, they say, good shares to have, but they're very expensive. And on the other hand, construction and worry about gold companies, for example. So how have you made the call on those kinds of balances between sectors?
Yes. Our views locally have largely mirrored our sort of bigger picture views with respect to the fact that developed market assets are more desirable. So we've tended to invest in companies on the Johannesburg Stock Exchange which are really exposed to global trends, be it MTN or Sasol or those sorts of businesses. We've actually steered, and Naspers has been a long-standing favorite of ours, we've actually steered clear of the sectors which have performed so very well. In fact, that's been part of the challenge for us. However, we just have not been able to justify some of the valuations. So the retailers have done, as been pointed out, phenomenally well. We think that many of the trends which have driven that very good performance for the retailers are the same trends which drive success, for example, in banking. But the banks, recently the banks have done well, but up until then banks have really been laggards, and if you look at their earnings performances, have not done as well as the retailers.
What's your sense in the newspapers this morning, the Basel III requirements, and saying we're 900 billion rand short, that's a number to upset you when things are uncertain. What's your sense of the kind of regulatory effect that's going to have on our banks?
I think that our banks overall are in a better position than banks in other parts of the world. We, for example, didn't have to bail out any of our banks. Our taxpayers were spared that, as many of the other countries have not been.
And now we're close to it, in fact.
Exactly, and I think that generally I think our banks are well capitalized. Some of it was good fortune in terms of when, for example, Standard Bank raised capital with the deal with the Chinese. So overall, I think our banks are in very good position. There are increased capital requirements coming through, but I think the hurdle's a lot lower for our banks to get to that point than it is for some of these global banks. And so, I think they'll do what's necessary and they'll be fine.
Let's look at a couple of your funds. You've got a list of awards you've won. I mean, you guys all list all the different awards that there are, and why not? But two of them that you do highlight is the Coronation Global Emerging Markets Fund, and then there's the Coronation World Equity Fund of Funds. Both of those, you say 5% of the MSCI Emerging Markets Index since 2008. The other one, 2% of the head of the World Index since 97.
Yes. We're very proud of those. Obviously, the Global Emerging Markets unit is a more recent development in the history of our business. We have been very pleased with developments there, and really in our sort of line of business, it takes quite a while for a product to be validated. You you really need the performance track record to be there. That division now has a 3-year track record. They're busy working on building their 5-year track record. Once they get to that point, you know, there'll be something that one can really talk about. The long term sort of matters in this, and that's the benefit that the other fund has going for as long as it is has been the World Equity Fund of Funds. It's got that very long track record and very happy. The two funds are very different. The Global Emerging Markets Fund obviously focuses on global emerging markets. They're very much in vogue. It's a directly managed fund from Cape Town. We have the team sitting there. Whereas the other fund is a fund of funds. We always quote the returns net of fees because of the sensitivity with respect to TRs in fund of funds. The building blocks that we use there and the managers that we use are not household names. They are businesses that we've built relationships with over more than a decade. So we're very happy with both funds' outcomes. We highlight those because we think that, you know, South African investors should be diversifying away from
Looking at the prospects, you say you will continue with what you call your rigorous investment philosophy, which you describe as capitalizing on underpriced investments. But you also caution against volatility. So it sounds like this will be a rougher ride than you've had.
Yes, if you look, just speaking fairly parochially about our business, if you look back over the last 3 years, it's really been a halcyon period in terms of performance, in terms of revenue generation and so on. And we think that, you know, nothing in markets, nothing happens in a straight line. So we anticipate a challenging period.
Which means not as good a growth as you've seen in this half?
I think rate of growth will be under pressure. But I think level of cash generation is fairly sustainable because of our cost base is essentially it's about 70% of it is variable. So it flexes with whatever, you know, happens. So we are very confident in that and we'll continue plugging away.